Hello and welcome to the Investing Edge. I'm Sumaira Abdi and with me is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management. Well, investors have always been searching for the most effective way to optimize their investments. But in their search for higher returns, we often forget the very basics. What's a good starting point to ensure that the foundation of your portfolio remains strong? Well, I intend to find out exactly that today. Hi, Feroze. I've often heard you advocate the balance sheet method of money management. So for the benefit of our viewers, can you tell us exactly what it is?
Sumaira, balance sheet method of money management is basically a holistic way of managing wealth. Finding out where you are, wherever you are today, and how your money is, and where will it get you in 10 years, 5 years, 20 years. Then see whether it makes sense for you to grow your money at that rate, or what is the other method to grow it at the desired levels. So balance sheet method is nothing but a holistic method of money management. It's contrary to transactional based money management, where you like an idea, you like a strategy, you buy it. You like a product, you buy that product. If you like a property, buy that property. That's very transactional in nature. It's like the journey deciding the end rather than the end deciding the journey. So that's the balance sheet method. In the balance sheet method, one needs to put across all his assets on an Excel sheet or a piece of paper. That's step one. All his assets. Assets are nothing but those which are not going to be consumed, and their sole purpose of existence is to create value in terms of numerical value rather than consumption value. So that's balance sheet. And then figuring out what is the return expected out of the current placement of this money is the balance sheet method's beginning. And that's not the end, of course.
Okay, Feroze, can you explain it with a case study?
Yes, Sumaira, I can definitely give you an example to explain the same. I think it's very important. Now let's assume a balance sheet of an HNI who has several assets. Hypothetically, there are assets which are medium risk. Let's take in this example, a person has real estate investments of 1.25 crores. Apart from the house he or she lives in, private equity investments, maybe a private equity fund or has bought some stocks which are unlisted, about 1 crore. Equity mutual funds of 65 lakhs, which could be across any of those 457 funds. So his medium risk assets is 2.9 crores out of the 5 crore. So that's 58% of his or her assets is in medium risk assets, real estate, private equity, and equity mutual funds, medium to high risk assets, you can call them. Then you break it down into low risk assets. Low risk assets, for illustrative purposes, fixed deposit of about 1.25 crore and a public provident fund accumulation over the years of about 85 lakhs. So this sums to about 5 crore total, out of which 42% is in low risk and 58% is in high risk. So this is a sample balance sheet. But in other balance sheets, several balance sheets, you can find far more complexities in the form of an insurance policy. You can have listed stocks in it. You could probably have hand loans in it. You could have a holiday home which you would never occupy other than the real estate piece. So there could be commercial property. So all this together is the balance sheet. Here for illustration, we've taken a 5 crore balance sheet and put in these 6-7 asset items which sum up to 5 crores under two heads: low to medium risk and medium to high risk and a low risk bucket.
So this is pure investment, right? I mean, like the realty portion of the portfolio, the balance sheet doesn't really or shouldn't ideally include a house that a person lives in. What else?
Yes, Sumaira, that's very, very important, because anything which you're going to consume has another objective, which is to provide a home for you, make sure that that takes care of your security needs, your other needs. But from an investment standpoint, the balance sheet excludes all consumption real estate for sure. A car doesn't form a part of your balance sheet because that's being consumed. A home which you have for your child, which he or she as a child might consume in the future, that also does not figure in the balance sheet.
Okay, so what's the relevant point B, or what are the relevant objectives that investors should have?
To my mind, the relevant objective is to first set an objective for a time frame of 10 years. If you look at 10 years, the time frame is plannable. You can have some degree of foresight. So 10 years is the period. And then if somebody could earn consistently about 15% over the next 10 years on a compounded basis, then the numerical value of the balance sheet should close to be 20 crores. It might take a year more if you're targeting 14%, or a year and a half more if you're targeting 14%. So quadrupling the wealth, which is 5 crore to 20 crore, should be the objective. And that becomes your plan, point B, which you wish to arrive at in 10 years period. So that's the point B. In the point B, you have to also try and articulate what are your needs of estate planning if something were to happen to the current custodian of the wealth over the next 10 years, which is likely. There would be some probability. So making sure that your estate planning needs are also mentioned at point B is critical. So having a target of 20 crores for this balance sheet of 5 crores should be the point B, with using a trust and a will or both of them to achieve point B, which has a very, very smooth succession plan as well. So that's the definition of plan B.
Feroze, how many investors really follow this method?
In our opinion, unless catalyzed by an external source like an advisor, not more than 2-3% of the HNI community, which is supposed to be the well-informed community, follow this method. So if this is presented by an advisor, like we have been for the years, good part of the decade, most clients think this is more logical to do, because if you're buying and selling products, you are actually fulfilling the desires of your advisor or your distributor, not yourself. So transactional methods are more advisor or distributor focused. Balance sheet method is more client focused. So most don't. So 2-3% would be the number, unless an external catalyst in the form of an advisor can push you and show you the merit of the logic to follow the balance sheet.
Okay, so what's the next step once somebody has created the balance sheet, and how do you actually put it into practice?
To put it into practice, once you have achieved satisfactorily the first step, which is drawing up the balance sheet to the second decimal, putting all the assets, the next step is to devise a strategy. To devise a strategy which helps you get to point B, there are so many elements of the strategy. The key decisions, sub-decisions to be taken so that it can all come together to become a strategy is: what are your risks which you're going to take? What are the product filters you have? What are the products you're going to use? What are the views you have on the 3-4 basic asset classes over the next 5-10 years? So views, product filtration, and risks, and hedging methods. This constitute the building blocks of a strategy which helps you get to point B with the highest degree of probability achievable.
Feroze, given the current scenario, what would you recommend is the right asset allocation for a portfolio that's geared towards the long term?
See, asset allocation in the current circumstance would be 65 favoring equity and 35 favoring debt. We still believe that for a 10-year kind of an objective you have set yourself to achieve in 10 years, a 65 into equity and a 35 into debt, 2/3, 1/3, would be a better strategy, better path to take, and should be able to mitigate the risks on the 10-year basis for sure. And I think that's not just which is important. At least at Anand Rathi, when we have 2/3 of money in equity, the volatility it brings along, we don't like as much. So what we do is we complement it with a protected equity, which is called structured product. So 65-35, to answer your pointed question, Sumera, is something which investors should not shy away from, because if that's not going to be the case, then achieving a target of 14-15% is out of the window. Even a double-digit return would be difficult for sub 50% favoring equity.
Is there any way by which one can hedge their portfolio against, say, a COVID-like black swan event?
See, I think whenever you think of hedging, you should first see what's your risk limit. Only if the risk limit is superseded by your structural portfolio design is when an external force to bring down risk is required, which is called hedging. So point one, if the standard deviation we at Anand Rathi like to pursue, which is 7.5, which is by design a low risk portfolio because Nifty is at 14, 15. So if your portfolio is designed at levels of 7.5, then you don't need an external hedge because the portfolio is designed that way. And structured products provide an inherent hedge to your portfolio because there's a protection of first 20% fall. If the limits are breached, then you can use different hedging methods. One or two popular methods is, of course, the usage of gold, which people use as a hedge. The other usage could be of using leaps, where you buy long-dated put options of 2-3 years, which help you insure your portfolio to the extent of the superstition or the increase in risk, which is not acceptable. If your risks have gone from 7.5 to 10, you have to do some degree of marginal hedging to bring it back below 7.5. So when it comes to hedging, please remember that as a viewer, please remember that you will have to have a limit. If your advisor has still not set a numerical limit to your risk, then he has not begun wealth management for you. And once that supersedes, Sumaira, your question of hedging is important. Two prominent sources. The more popular one is gold. The lesser popular yet effective method is a leap.
Okay, so just to wind up then, Feroze, can I ask you to just summarize the key facets of this entire balance sheet approach to money management?
Let me summarize the entire process. One is balance sheet formulation, balance sheet crystal clear formulation of balance sheet. Step 2, objective definition, right? To find out where you wish to be 10 years from now. I would like to, as an individual, grow it to 4 times in 10 years. Somebody else might be satisfied with 3 times the wealth multiplication over 10 years. That's objective setting, which is personalized, which is dependent on what that individual wants to see from his wealth. The third step is strategy. In strategy, 4 sub-steps of fixing principles, risks, products, views, and hedging methods. That's step 3. Step 4 is rigorous implementation, that transforming the current portfolio construct to the desired portfolio construct, which is permissible, will take you a year. So that 1 year, 6-month process of transformation of your current product mix to the desired portfolio, that is implementation step. And the last one is, of course, monitoring, where you monitor to see all the objectives are being achieved, or is there something which has happened in the external factor which completely puts your plan off track, bring it back to track. Or maybe sometimes the objective which you set for yourself might look stretched because if a pandemic has come in that period, you might wash away 1-2 years of return. So you may want to relook at your objectives. So that's the last step of redesigning objective or redesigning a portfolio. And after having monitored the direction in which you have progressed over the 1, 2, 3 year period, you've already embarked on this journey.
All right, on that note, let's take a very quick break. We're going to be right back. And up next, we're going to talk about the implications of the Karnataka High Court's judgment in the Franklin Templeton case. Money management, and now for something that's more current. The Karnataka High Court delivered its judgment in the Franklin Templeton case on the 24th. So while the Chief Justice said that they found no wrongdoing on the part of the trustees in their decision that they took to wind up the 6 affected schemes, but it did say that the consent of the unit holders should have been taken. So as well, they have stayed their own judgment now for 6 weeks to allow for appeal in the Supreme Court, which at this point looks like it's going to happen. But let's focus on the unit holder vote because, you know, that might change the equation entirely. So Feroze, what would you say are the key takeaways for investors and how should they approach this vote?
The key takeaway for the investor, to my mind, after this judgment of the Karnataka High Court, is one is I'm happy that the speed at which this is progressing. Otherwise, you would expect a larger gestation period. So point one, the one thing which is clear is that the process could have been followed better in terms of some degree of democracy being exhibited before having closed these schemes. That needs to be done now. To my mind, from a from a voting perspective, if that gets voted, my expectation is, my assumption is that most investors will vote against having wound it up. So once it opens up, everybody will try and get the money immediately. So people will give their redemptions. If that were to happen, the fund manager will be compelled to sell the portfolio at ridiculous prices in the marketplace. But fortunately, since the pandemic has panned out reasonably better than what was envisaged in the month of March and April, these securities will not be sold at such distress. So point one I'm making is, I think it will progress faster than I thought. That's pleasant. Second is, if everyone were to vote, it's very likely that a group of investors who are emotional today would vote against the winding up. If that were to happen, you will have to be ready to place your redemptions because you don't want the last one to redeem. And if you were to redeem, the fund manager today will sell those securities at a discount. But since the liquidity has improved over the last 6 months, given the wonderful action taken by RBI and the government and SEBI, the liquidity is there to not sell these bonds at 40-50% of their value, which could have happened if this happened in the month of April. So I'm very happy that the 6-month period has been traversed, and I think investors would be better off having had closed it for the 6-7 month period. Even if it had to be opened, I think a 10, 15, 20% discount should be good enough to sell these securities and repay the money. So there will be a markdown on the NAV, but not as bad as it could have been if this closure hadn't happened in the month of April.
Okay, Feroze, just to clarify then, should investors, how should they go about the vote itself? I mean, should they vote to reverse the winding up or continue with the process? I mean, what according to you would be in their best interest?
See, investor interest, two investors could have two separate interests. One who desperately need for liquidity. I think for him, a 10-20% discount shouldn't matter because that's not back-breaking, that can be recovered. Somebody who's a long-term investor who doesn't need the money, because a mutual fund platform has varied kind of people. So I think it's anybody's guess what's best in the interest. From a price perspective, the best is to let the fund manager sell it in a due course of 1-2 years. From a price perspective, from a liquidity perspective, this is a good action to undo the unwinding, undo the wind up, and open it up again with some preparation, of course. So I think both sides of the coin could have some benefit, but I think the vigilance has to go up for an investor. Either way, he can't be just relaxing on it like he could have over the last 6 months. So be very, very clear. Whatever the shape it is taking, your action is needed. If you think the winding up would be, the closure would be undone, you have to be very agile to send your redemption first in, and not wait for any degree of period of 1, 2, 3 months before you send your redemption. I think lastly, I am happy either way now because it is timely. It is timely. It would have been a disaster if this was not shut for those 6 months period during the pandemic.
Feroze, thanks much as always for making the best wealth management lessons available for our viewers. With that, let me hand it over to Vimala Thithan N, the Chennai unit head of Anand Rathi Private Wealth Management, for some interesting mutual fund analysis.
Thank you, Sumera, for having me on the show. We will be evaluating Aditya Birla Sun Life Equity Fund today. Our rating for the fund is 2 out of 5. Aditya Birla Sun Life Equity Fund is an open-ended equity scheme, which is investing across large, mid, and small cap stocks. The fund was launched by Aditya Birla Mutual Fund, housed in 27th of August, 1998. It's almost 22 years. According to SEBI categorization, this fund falls under the multi-cap category. And as on September 30th, 2020, the fund has an AUM of about 10,832 crores. The fund is managed by Mr. Anil Shah since October 2012. And he comes with about 25 years of industry experience. He follows a blend strategy, which is basically picking a mix of growth and value stocks But however, this fund is a little skewed towards growth stocks. The fund is well diversified, has a well diversified portfolio of about 64 stocks spread across 10 to 11 sectors. And as on September end, the fund has invested 98% of its assets in equity, and the balance 2% is in debt and cash equivalent. Within equity, the fund has maintained an allocation of 67% in large cap and the balance 33% in mid and small cap. We evaluated the fund at Anand Rathi, as per Anand Rathi ranking methodology, on various futuristic and historical parameters such as return consistency, risk, valuation, fund manager's stock picking capability, return potential, among others. And as per our evaluation, the fund scored below average as compared to its peers on most of the parameters such as risk and standard deviation. However, it managed to get an average on parameters such as standard deviation alpha, as indicated by lower tracking error than the category average. So we would like to give a rating of 2 out of 5 for this fund. From performance standpoint, which is measured by rolling returns, the fund has managed to generate returns which are lower than the category average. If you look at from a 3-year investment perspective, a 3-year annualized rolling returns of the fund is minus 1.5% compared to the category average, which is minus 1.1%. Whereas Nifty for the same period has given a return of 1.3%, a positive 1.3%. Moreover, from a risk standpoint, which is measured in terms of standard deviation, the fund has significant risks associated to it as indicated by its high standard deviation. The 3-year standard deviation of the fund is 22.67, significantly higher than the category average of 21.26%. Nifty has a 3-year standard deviation of 21.25%. From a valuation front, the fund scores low as it is relatively costlier than its peers, indicated by higher PE and PEG ratios, right? Indicated by higher PE and PEG ratios. This is mainly attributed to the fund manager's style of investing being skewed more towards growth stocks. So if you have invested in this fund 3 years ago, if it invested about $1 lakh, today the value would be about 1,06,000. Whereas if it invested in Nifty, you would have got a return of 1,17,000 end of 3 years. So we would give a rating of 2 out of 5 for this fund. And this is our rationale. Thank you.
Vimla, thanks very much for that. And with that, we wind down on the Investing Edge for this week. Thanks very much for watching. Stay tuned to CNBC TV 18.